A master limited partnership, dividends, taxes, retirement. That's all the things that we're going to be talking about today. Welcome to another episode of the Retirement Learning Lab. My name is Van Richards. I'm a financial advisor, and I'm here to help you grow your financial knowledge so that you can be in control of your financial future. We're talking about a really interesting stock today. We're talking about enterprise products, and it's not a stock, it's a master limited partnership. That's what I mentioned in the very beginning. It's a little bit different than a stock, a company that issues stock, but we'll talk about that as we go along today. So let's go ahead and begin today with today's Retirement Learning Lab. We are live today, so if you have a question about enterprise products or some of the dividends stocks that we talked about in the past, please feel free to enter it in and I'll get to it toward the very end or as we go along today. Also, hey, let me know where you're listening from. I found it very interesting this past week to listen to some of the comments that came in and to read some of the comments that came in. And I found it very interesting to see where some of you are listening from. We have quite a few people that are from the United States that are listening, especially around here in Houston, where I live. But we also have fans. I have fans, I hope, in Europe, in Asia, in South America. And I want to know where you're from. Let me know where you're listening from today and give me a thumbs up in the comments and let me know that. Okay, the very first thing that when we're talking about any particular stock, when you're thinking about buying it, the very first thing that you should do is you should get an understanding of what that stock does. Now, I've said this before, but I like listening to Dave Portnoy. I think he's really entertaining. But there was one thing that he said earlier in the summer when the market was going crazy up. He said, I don't ever look at what the company does. Well, maybe I'm paraphrasing that. I don't want to say it's a direct quote, but he said, I don't know what this stock does when someone asks him that question. He says, I just know it's going up. But I don't think that's the right thing to do when you're looking at a stock for the long term. I think it's really important that you get an understanding of what that stock does. That's why understanding what enterprise products does is so important. So let's take a little lesson here and see what enterprise products actually does. Enterprise products is a midstream oil and gas company. Now, in the oil and gas industry, this is just a little bit of a primer for you, for those of you that are not very familiar with it. But you have upstream, which is basically going to be the oil and gas production. Then you have midstream, which is going to be the energy infrastructure. That's going to be the transportation, that getting it from the production spot. And then the downstream is basically where it's going to be the distribution to you, the customer. But with enterprise products is a midstream energy infrastructure company. Their job is to get it from wherever it's being produced to the customers in itself. They have four core businesses. They have natural gas liquids, crude oil, natural gas itself, and petrochemicals. And we'll talk about those sections just a little bit more. Now, when we get into looking at what this stock does, the first thing that I think that's important to do is you need to take a look at the company's fundamentals, do a short fundamental analysis. I have a technique that I've used over the years that I call SEC, and it stands for stability, earnings, and competitiveness. The first thing that we want to do in looking at the stability of the company, really, how big is it? You hear that Enterprise Products is a big company. Well, it's around $51 billion. When you compare it to like the Exxons of the world, it's not quite as big. When you look at midstream companies, it is quite big. One of the other stabilizing factors with this company is they have a huge diversification of pipelines. If you're listening to this on a podcast, I want to tell you, I've put on the screen a map of the United States. It has all these lines going all over the place. Well, the point is that the diversification of their pipelines is that it goes through about 48 different states. They have so much going everywhere. So it's well diversified from that standpoint. They increased their footprint recently. At the beginning of January, there was an announcement made that Enterprise Products Partners was going to acquire a competitor, a little smaller, called Navitas Midstream for $3.25 billion. Now, what's that do? This actually adds to the company's stability because it gives them a bigger hold in the Permian Basin in West Texas, which is a really important production site for them to have a hold of. Some of the operation highlights is that it adds about 1,750 miles of pipeline, and that actually increases the production capacity to around 1 billion cubic feet of natural gas per year. Now, an interesting thing is about the Permian Basin, 1 out of 5 drilling rigs are in the Permian Basin. There's about 40 different operators that Enterprise Products has access to at that point. Now, that's a good thing and that's a bad thing, but it's just the nature of the business. We're going to talk about that more when we get to the section called bulls and bears. So stick around for that. I think that you'll get something from that. Now, the advantages of this acquisition increases the stability. Remember the SEC, that's what we're talking about. The acquisition of Navitas actually helps the partners, that would be the shareholders, by adding about 20 cents per distribution per unit of distributable cash flow. That's an important term that I want to talk about just a little bit as we're going along. Because remember in the very beginning, I told you we're going to talk about retirement and taxes just a little bit. This company, as a midstream company, has some unique advantages that it offers to people who don't like paying taxes. We'll talk about that just a little bit. I don't know anybody that does like paying taxes. If you do, leave me a comment and let me know why. I'm not sure why. But to going on now, the advantage of that 20-cent increase in cash flow, distributable cash flow per unit, is that it increases that unit by about 13.56%. That's an increase in the cash flow in itself. Now, some of you may be saying, what the heck is a distributable cash flow, if I can get it out? This is a really important term, the distribution of cash from any business operations. Now, partnerships can have DCF, or distributable cash flow, and they can also have dividends. Now, dividends are actually taxable to the partner. Remember, the partner, that's synonymous with the shareholder. The DCF is actually a return of principal. Now, let me explain to you in a very, very simplified example. Now, I'm not trying to, dumb it down here. I'm just trying to basically not get sued for offering you tax information, because this is very simple from my standpoint. I had one lady that came to me and said, can you explain this to me in Elmo language? Well, okay, this is in Elmo language, friends. This is for me, and this is my friend that needs to have a basic understanding. Let me give you an example of that DCF, the distributable cash flow. If you make a $100,000 investment into a limited partnership, and let's say that partnership had a $10,000 distribution, it's possible the way that distribution that's being paid out to you as the partner, the shareholder, that $10,000, let's say, as an example, not for real, example, that $10,000 is broken down into 2 different parts: the DCF, or the distributable cash flow, and the dividends. In this example, let's say that 80% of that distribution was the DCF. That is a return of capital to you, the unit holder, the shareholder. The $2,000 is going to be a dividend. So what that means is that dividend is taxable. The DCF, the $8,000 DCF, is a return of principal. So what's that mean to you? What happens now is you have, let's say that $100,000, it didn't change in value. This is hypothetical, okay? So let's say that $100,000 now is worth $108,000. So your capital gain would be, that is, if you sold it, you would pay the difference between $108,000 and the $100,000. Now you got that, actually that distribution, you could reinvest it, you could spend it, you could do whatever you want to with it, but you weren't taxed on it yet directly. It's considered a capital gain under current tax laws. So that capital gain now increases your distributable share to $108,000. So the tax gain is going to be $8,000 that you would declare on a K-1 form that you would fill out when you do your income taxes. Now, I'm not going to get into the weeds and talk about taxes a whole lot today, but if you use TurboTax or any type of software, it'll take care of that for you. This is a really simple thing to do. You can even fill the form out yourself if you do your taxes by hand, but you probably don't. You probably use someone to do it, or you use the tax software. So it's really simple. But here's the benefit. That $10,000 distribution, $2,000 was taxable, $8,000 wasn't. Now, here's a really interesting thing that's going to happen. When you die, you get your estate to your heirs gets what's called a step up in basis. So that means that there is no income tax. Now, that's under current tax law. Congress and the White House wants to change that, but so far it's not. We're not going to get into that. But it's a step up in basis. There's no income taxes on it. So it's possible that if you keep this forever and you just keep taking the distributions from it, then there's going to be no income taxes that's payable on. Okay, that's our short lesson today. As we're going on and we're looking further at the stability of the company that has a high financial integrity, the three major rating companies, Moody's, S&P, and Fitch, all rate them as triple B. Remember that when we're talking about companies like oil and gas industries, you're not going to get AAA, so don't be looking for it. You can get higher rated maybe from some smaller companies, but you can certainly get lower rated. Financial integrity is really important. Now, when we're talking about distributions, like we were talking a moment ago about the DCF, they have a history. That is, Enterprise Products has a history, a 23-year consecutive payouts and increases in their distributions, getting close to being an aristocrat stock, not quite. They actually just increased their distributions to their partners, and that was announced on January 7th. It went up to 46.5%. Now that brings their yield to 7.87%, and we all love dividends, don't we? Just give us a little interlude there, a little bit of a punch to the fact that this does pay a really high dividend. And you may be wondering, can it continue? Well, we'll talk about that a little bit more. Now, through a lot of this that we're talking about, I'm giving you some of the points of, these are the high points. These, maybe you might be looking at this as, these are reasons to buy this stock. So you have to determine yes or no. I'm not here to give you direct advice. I'm here to give you some facts so that you can make good decisions on, to grow your financial knowledge so you can make better financial decisions. Now, if you're wondering, when should I sell this stock? I have a special resource that's available for you that I want to tell you about. Go over to whentoselladividendstock.com. And there is a short video lesson that'll give you the pointers that I utilize when I'm trying to determine whether there is a stock that I need to sell. And it works with companies like Enterprise Products or any other company as well. So let's keep going on today. We're going to talk a little bit more about the stability aspect. And I refer back to what Warren Buffett says about the stability and the fundamentals of a company. He says that really what he looks for in a business is economic castles that protect the unbreachable moats. That's a quote from him. And the moat is basically that barrier that's between the company and its competitors. And that's what we want to look at with Enterprise Products. And really, I think that Enterprise Products has two significant moat characteristics. The first one is they do have proprietary assets that can't be duplicated, and their size advantage has a big deal going positively for them. When I talk about the proprietary assets, that happens on many different levels. Quality assets really are those assets that they can't be duplicated. You just can't duplicate their access to ports. You can't duplicate their pipelines. It's extremely difficult. Location is really another proprietary asset. We'll talk about that too. The contracts are very strong. They're generally very, very long, between 15 and 20 years. The size advantage comes from what we talked about a few moments ago, and they have 4 core business segments. They have an expansive pipeline network, and they have export hubs, dock access in several different areas. And I want to emphasize that just a little bit. They have a wonderful partnership going with the Houston Ship Channel. They also have their own distribution terminal called the Enterprise Hydrocarbon Terminals. That's unique because if you're looking at the screen, you see this big ship there. That is a Suezmax ship. That's a Suezmax tanker. That's the largest tanker that can go through the Suez Canal. And those tankers can be accommodated at the Enterprise Hydrocarbon Terminal. That's a hard to duplicate benefit that they have available. They also have footprints as far as terminal access in Beaumont West, Freeport, and Texas City. And we'll talk more about some of the others as we go along. Now, let's get into talking just a little bit now about the earnings of the company, because remember, we're going to that SEC that we talked about. They have actually tomorrow, today is January the 31st. Tomorrow on February 1st, they will have an earnings call. Their fiscal year begins in January. They're going to be releasing their fourth quarter information tomorrow. So if you look it up on the web, you can find more information about that. And I'm sure it'll be in the news quite a bit. Now, I want to make this just a little bit bigger for you. If you're watching, if you're listening, I'm going to describe it to you. This is a graph that's showing the earnings history of enterprise products from 2015 to 2021. And the graph itself, what you're looking at is the solid line is going to be the actual earnings. And it's a good thing because what you're seeing is you're seeing a gradual increase. You will see some decreases in particular years, like, of course, in 2020. I can't imagine what happened back then. I think something called a pandemic. Anyhow, if you keep looking, they have recovered pretty well, and they've been continuing on from that standpoint. So their earnings have continued to increase as time has gone by. But I do want to remind you about something. Remember that the past performance can't be a guarantee of its future results. Now, in the next graph that I'm pulling up, it's the consistent history of the return of capital to partners. Remember, we talked about that DCF, that distributable cash flow. This shows you what percent of the actual cash flow is going back to the partners, that is the shareholders. Now, the interesting thing is there has been such a increase in past years that they've been able to use some of that cash flow to buy back shares. And that's a good thing, because when you have share buybacks, do you know what that happens to that? What that helps with? That helps so that the distributions going out to the current partners is not diluted. So it gives more to the actual partner. So that's a good thing. Again, the dividend yield is around 7.87%. And as we continue on going on, we're talking about the earnings. Then we're going to talk a little bit more about the competitiveness of the company. The spaghetti graph that I threw up in front of you just for a moment just shows you some of the different competitors that Enterprise Products has. And you'll find that they're, if I can get to it properly. Here we go. What we're looking at is the competition with Magellan Midstream, One OK, and Kinder Morgan. Now, I'm going to back up just a little bit, because what I want to do is I want to go back and look just for a second at the returns over the past year, because it has had good returns, as has its competitors. When we look at Enterprise Products with OK1 and Kinder Morgan and Magellan Midstream, all of them had good years in the past 12 months. OK1 was the largest at 53.83%. Enterprise Products was at 24.55%. Kinder Morgan at 26.85%. And Magellan Midstream was at 18.04%. Those are all good things. But I'm going to show you the next screen, and I want you to pay real careful attention to this. The point that I want to look at here is that the last 3 years, things have been flat. So if we look at Enterprise Products, the return on the unit value, the share value over the past 3 years is actually down 10.38%. Magellan Midstream is down 0.48. One OK is down 20.48. Kinder Morgan is down 17.17. So you have to ask yourself, why would I want to buy this stock? Well, let me tell you something. The idea is the dividends. The dividends, the distributable cash flow is the big benefit to this stock. We have to remember that the past performance can't be a guaranteed future results. But the point is going to be, we're looking for cash flow. Okay. I want to get into something here really interesting today. We're going to look at the bulls and the bears. This is what the bullish analyst and the bearish analyst are saying about Enterprise Products. So if we look at it from a bullish standpoint, the very first thing is going to be that Enterprise Products actually dominates the natural liquid gas distribution. Their connections through the Houston Ship Channel, through Beaumont, through their Mont Belvieu locations, all gives them that type of footprint that can't be duplicated. Their other benefits are that they're having a large expansion into petrochemical activities. Their propylene pipelines, their propane dehydrogenation, their iButane dehydrogenation, All those facilities are what we're talking about when we're talking about hydrocarbons and the expansion into that particular market. If we look a little bit further, we can see that they also have marketing operations that a lot of analysts consider a very bullish aspect of the company. Now, what I mean by marketing operations is when they receive some of those different hydrocarbons, some of the different, let's say whether it's going to be oil or whether it's going to be gas, if they actually are able to store that and then they are able to market it, they get the difference in between what they bought it at and what they're able to sell it at. So the marketing operations expanding is a huge benefit. I love the bearish aspects because of the bear growling, not really because of the fact that it might go down because of this. But what I want to get to is that these are the points that you as a potential shareholder or as a shareholder should consider if you want to hold on to the stock and ask yourself, why should I sell this thing? The thing is that the market, there is a narrow marketing spread. Just a moment ago, we talked about the marketing aspects so that they would be collecting the different hydrocarbons, storing them, and then selling them, depending on timing to whomever. That spread is going to be narrowing as time goes by. And there are quite a few analysts that say that that is a negative aspect of the company. If that company, if Enterprise Products has declined in their natural liquid gas distribution to China and India, that's also going to hurt profits. It's going to be a huge impact on profits. Also, if there's a reduction in U.S. demand, that could leave pipelines underutilized. So if we have a lot of things going on with social pressure or environmental pressure and the usage of their products is less, that could be a bearish aspect. Now, another thing that we have to also consider, remember earlier when I talked about Enterprise Products acquisition of Navitas, we talked about the fact that there are 40 different drilling companies that operate around in the Permian Basin. Well, all of those have their own contracts. Each one of those also has its own financial risk. So there are vulnerabilities that companies, not just Enterprise Products, but all companies have when they have contracts with the upstream companies. If the upstream companies go bankrupt because their drilling operations can't continue, they can't fulfill their contracts, it really hurts the midstream companies. So that's a big thing. The last vulnerability that I want to talk about is going to be the governmental interventions. There can be environmental interventions. A big one right now is that there can be different types of carbon taxes that could be imposed. That's not a big problem with midstream companies, but it is a problem that they have to take into consideration. Now, let's look at what the valuation is on the company. Actually, I get this information from Morningstar, and I like it a lot because it gives me a good understanding of maybe what the high and the low of the company may be. When we look at the valuation, Friday's close, it's probably a little higher today because the entire market has been up, but Friday's close, it was at $23.66. Morningstar is saying that the fair market value for Enterprise Products is actually $25.50 doing their technical analysis and their fundamental analysis. That means that under their estimation that this company is selling at a discount of 7.22%. That puts it as a 3-star fund. Now, the star designation, I mention this a lot because if some of you haven't listened before and you're familiar with the star designation for Morningstar, you might be thinking, 3-star kind of Don't go by that understanding because it's wrong. Don't use the concept of the stars that's utilized with mutual funds when you're looking at stocks. The only thing, maybe not the only thing, but the primary thing that the stars do in the stocks that are analyzed by Morningstar is it indicates the value. If it goes down to, let's say, $20 a share, they may indicate that there's a lot more potential. So it may be a 4 or a 5-star stock. If it goes up in value to $30, it may go to a 1-star. That means there's not a lot more room to grow there. So keep that in mind when you're looking at the star designations. Let's look at what the analysts are saying from this. There are 11 analysts that are reporting on Enterprise Products, and actually one of them are saying that this is a hold stock. However, 10 are saying that this is going to be a buy. So the idea is that the majority of analysts do have a very positive impression of enterprise products, and they have a strong buy on this particular stock. Now let's look at what some of the individual analysts are saying. The most recent review was done by Muzo, and that was on January the 11th. And what they're saying is that they're estimating that the spread is going to be between 29 and 30. That's what they're looking for. The most speculative, let's say negative, is going to be with Wolf Research. Wolf Research is only pegging it at around $24. But look at the date that they put that out. That date is from October the 19th, 2021, from last year. Look at the more recent analyst information from Muzo, Morgan Stanley. Actually, Wells Fargo was just in December. Morgan Stanley and Wells Fargo are putting their highs, their spread, let's say between $30 and $27. Now, when we look at what that looks at like from an upside and from a downside potential, Muzo is actually saying that there's a 27% upside potential to enterprise products. On the highest one is actually Wells Fargo. Wells Fargo is saying that there's a 29% upside. And then Wolf Research actually has the negative numbers. They're saying that the downside is 2.32%. But the majority that you're seeing here, the majority of analysts are having a very positive view of enterprise products. Okay, so if we go back and we look at it from the standpoint of what we were discussing, that is looking at the stability of the company, the earnings, and the competitiveness. That's what you want to look at when you're looking at, should I buy this stock or should I not buy this stock? Now, remember, buying a stock is not always the main idea. You have to have an understanding of when you're going to sell it. So use the resource that I've made for you. You'll find it at whentoselladivendstock.com. If you go over there, there's a very short video lesson. It's about 10 minutes long, and it's me giving you some of the pointers on what you should look for when you're trying to determine to sell a stock. Okay, friends, that's everything for today. I'll look real quick and see if we had any questions. If we didn't, I do have a question or two that came up during the week. And this one was when I was preparing this, it says, how much money does Enterprise Partners make? And that's actually a pretty easy one to answer. So in doing a little bit of research on it, Enterprise Products has a market capitalization, as I mentioned at the very beginning, of around $51 billion. Actually, it's around 51.76. They generate $27.2 billion a year in revenue. And the company itself, this is from last year. You can find more about tomorrow when you look at their earnings call. The earnings, that the net income from last year was $3.78 billion. So that should give you a little bit of an idea. That's around $1.78 per unit that was distributed. Hopefully that's been helpful to you. I want to remind you too that stick around for just a real brief moment, because I have to give you some disclosure information about important things that is my limitations in itself. So you can go back and watch the reruns and the replay of it and find the information that you like. I'll look forward to talking to you next week. Have a good week.